The Federal Reserve's ability to create limitless amounts of money makes it the world's most powerful economic institution. Since 2008, the Fed has exerted its power on a nearly inconceivable scale. Between the end of 2008 and mid-2022, the Fed created $8 trillion, increasing the size of its total assets by 9 times in just 14 years. In this way, the Fed prevented economic collapse twice, first following the crisis of 2008 and again during the COVID pandemic. This is also the principal reason why wealth in the United States has skyrocketed since 2008, from $61 trillion then to $164 trillion now. When the Fed creates money, it loosens monetary conditions, and that tends to stimulate economic growth and drive asset prices higher. When the Fed destroys money, it tightens monetary conditions, and that tends to slow economic growth and depress asset prices. The Fed's power to create and destroy money gives it unmatched influence over how quickly the economy grows, as well as over the direction of asset prices. Therefore, anyone who wants to understand how the economy works at the macro level, or to understand the forces driving the financial markets, must begin by learning how the Fed creates and destroys money. This video, the 8th in the Creditism 101 series, will explain that process. It will do that by showing viewers how to read and interpret the Fed's weekly H41 report, which is also called the Factors Affecting Reserve Balances of Depository Institutions. This is perhaps the most important report published by the Fed, since it provides all the information required to understand how much money the Fed creates and destroys each week. Here's the URL. And here's what the top of the H41 report looks like on the Fed's website. We'll look at this report in detail, but before we do, let me begin with a quick overview of some fundamental information regarding money and how the Fed creates it. The public generally understands that the Federal Reserve has the power to create money. While the Fed does have the power to create money, money is not what it used to be. Before 1968, money had to be backed by gold. After 1968, it no longer does. Today, the Fed is not required to hold any gold to back the money it creates. Today, what the Fed really does is create and extend credit. The credit the Fed creates is called by two names, either Federal Reserve credit or Reserve Bank credit. Both terms mean the same thing. The Fed creates credit in two ways, by acquiring bonds or by making loans. When the Fed acquires a bond, it pays for that bond by making a deposit into the reserve account at the Fed of the commercial bank from which it bought the bond. Every commercial bank has an account at the Fed. The money in those accounts is known as bank reserves.